Good afternoon. Somebody in Shanghai built 5 machines, and the global chip complex lost its mind. A state-backed Chinese firm began mass-producing its own immersion deep ultraviolet lithography tools. That is the one category the Dutch company ASML has owned outright for a decade. By the Asian close, that report had taken the Korean market down 10.84%, tripped a market-wide circuit breaker, and handed Samsung its worst single day since October of 2008. Now here is the part almost nobody said out loud today. China's target is 5 tools this year. ASML shipped roughly 131 of them in 2025 alone. What got repriced this week was not anybody's revenue. It was the belief that export controls hold forever. And underneath all of it sits the thing that is genuinely underpriced. The Federal Reserve is meeting right now, and the live debate in that room is a rate increase. Let's take it in order. Here is the board. The S&P 500 closed Monday at 7,413, up 0.02%, effectively frozen. The Dow rose 262 points to 52,210. The Nasdaq fell about 0.2. And in Korea overnight, the KOSPI closed at 6,023, down 10.84%. Gold slipped about 1% to roughly $4,031 an ounce. Bitcoin fell about 2.8% to roughly $63,200, an 11-day low. West Texas crude sits near $81, down another 1.75% after shedding nearly 8% on Monday. Fed funds are at 3.5 to 3.75%, with the committee meeting as we speak. Now look at the shape of that board rather than the levels. The Dow up, the Nasdaq down, and the S&P flat is not a calm tape. That is a rotation wearing an index disguise. And in Korea, only 36 of 917 listed shares advanced. Samsung and SK Hynix are more than half of that index by weight. When 2 names break, the index is the 2 names. First read, consensus says China just broke ASML's monopoly, so sell the semiconductor complex. The tell says something narrower and more durable. The tool is real. A state-owned Shanghai firm, 5 units targeted for this year, about 20 for next year, headed to the big 3 domestic chip makers. But by every account, including the reporting that triggered the sell-off, that machine still depends on Japanese components, and it still lags ASML on performance. So what actually happened is not a market share event. It is a proof of existence event, and there is a real distinction there. The market repriced a decade of terminal value certainty in a single session, on a number that does not move next year's revenue at all. Our read, with high conviction, is that the reaction overshot the 2026 and 2027 profit and loss badly, and with equally high conviction that the long-run monopoly premium genuinely does deserve to come down. Both of those are true. Most of the commentary today picked one. Put the 2 numbers next to each other, because this is the entire mispricing in one line. 5. That is China's target for immersion deep ultraviolet tools this year. 131. That is roughly what ASML delivered in 2025 alone, on a 98.7% share of that market. On that ratio, the semiconductor complex staged its worst Asian session since March. Korea tripped its 8th circuit breaker of the year. And Samsung printed a drop it had not seen since the global financial crisis. Markets do this. They reprice certainty long before they reprice cash flow. Nothing about next year's ASML revenue changed on Monday. What changed is that the sentence "there is no alternative supplier" stopped being true, not in volume, in existence. And existence is the thing a terminal multiple is built on. The honest counter, and you should hold it, is that a proof of existence has a habit of becoming a proof of scale faster than incumbents assume. Second read, consensus says the artificial intelligence trade is cracking on demand doubts. The tell says it is cracking on financing doubts, and that is the worse of the 2. Nvidia is reportedly in talks to guarantee up to $250 billion of lease obligations so that OpenAI can occupy a 10-gigawatt campus in Piketon, Ohio, built by SoftBank's energy arm. Separately, discussions cover as much as $350 billion of accelerators. Now, the reason that guarantee has to exist is the whole story. OpenAI has no investment-grade credit rating, so Nvidia's balance sheet gets rented out as a substitute for one, and lenders price the debt against Nvidia's credit instead of the tenants. The investor Michael Burry's entire published commentary on it was 5 words: Around and around we go. Two cautions, and they matter. These talks are early stage and may collapse. Both CNBC and Axios flag that explicitly, and we are reporting talks, not a deal. And the signal here is not the number. The signal is that the market now reads a vendor guarantee as a liability rather than as a demand indicator. That is a change in how this entire category gets valued. Here is the structure as reported. $250 billion covering lease and construction obligations, $350 billion of chips, discussed separately outside that perimeter, a 20-year lease, an 800-megawatt first phase targeted for 2028, a total build-out estimated near $500 billion, and a tenant that cannot carry an investment-grade rating on its own. Watch that perimeter because it is load-bearing. As long as the chips sit outside the guarantee, the supplier is underwriting the building and not the purchase. If a final structure ever pulls the chips inside it, then the supplier is financing its own revenue, and the accounting question stops being academic. That is the single line item worth tracking in this deal, and it is the one most of today's coverage skipped straight past. Third read, and this is the one almost nobody is positioned for. Consensus says the Federal Reserve's next move is a cut. The tape says the next move might be an increase. The Federal Open Market Committee is meeting today and tomorrow. Rates sit at 3.5 to 3.75% under the new chair, Kevin Warsh. Markets put roughly a 1 in 3 chance on a 25 basis point increase tomorrow. And September increase odds have climbed to around 82%. June headline consumer price index inflation ran 3.5% year-over-year, cooler than May's 4.2 and still nowhere near the mandate. 9 officials have penciled in at least one increase this year, so sit with the setup. Equity weakness is arriving into a central bank that may be tightening into it. There is no rescue bid priced anywhere in this market. High conviction that this, not China, is what the second half of this year gets repriced around. Follow the money and start with why gold did not work today. Gold slipped about 1% to roughly $4,031 an ounce, below $4,100, with the dollar sitting near a 4-week high going into the decision. That is the mechanism. Gold is not failing as a hedge. It is being outbid by the dollar while real rate risk points the wrong way. When the hedge and the funding currency both want the same flows, the funding currency wins until the decision clears. Crypto told you the identical story, only faster. Bitcoin fell to roughly 63,200, an 11-day low, with Ether down harder near 1,872, and that move was not chip contagion. It was rate increase positioning, plus the Asian equity wreck arriving in the one market that was open to trade it. Bitcoin remains the highest beta expression of the front end of the yield curve. And today it behaved exactly like it. One honest note on the long end. The 10-year did not rally. There was no flight to quality bid despite genuine equity stress, and we are going to leave that qualitative because our sources disagreed on the precise level and we are not going to voice a number we could not pin. Oil went the other way, and the direction matters more than the move. West Texas crude is near $81, down 1.75% today after shedding nearly 8% on Monday, with Brent in the mid to high 80s. The driver is de-escalation. Strikes have paused, and talks are being described as underway. And here we have to be careful, because there is a genuine dispute about whether those talks exist in the form claimed. The American characterization is that they are substantive. Iran's foreign ministry has publicly said it has no negotiations with the United States at all, and that its only talks are with Oman regarding the Strait of Hormuz. We are carrying both of those because only one outlet in our entire monitoring set carried both. So the tape is priced for a resolution that one principle denies negotiating. That asymmetry cuts one direction. The downside surprise is louder than the upside, and a correction we owe you in the open. Our own inbound sentiment data today carried crude roughly $10 to $15 too high, apparently by absorbing a bank's late-year forecast as a spot price. We caught it, we corrected it, and the numbers you just heard are the verified ones. Now the story almost nobody covered, and it is the one that actually matters for the incumbents. In the same week China demonstrated the tool, it capitalized the customer. CXMT closed its Shanghai debut up 466% at 49 yuan against an initial offering price of 8.66. It raised 57.92 billion yuan, roughly $8.6 billion. That is the largest mainland semiconductor offering on record, and the second largest mainland listing of any kind since Agricultural Bank of China back in 2010. Its market value of about 3.3 trillion yuan, call it $488 billion, makes it the most valuable onshore-listed company in China, ahead of ICBC. And this is a company that held 7.67% of the global memory chip market last year. So inside 7 days, it got a public balance sheet and a domestic tool supply. That is the real bear case for Samsung and SK Hynix. And notice, it has nothing to do with sentiment and nothing to do with today's headline. It is capital formation. Sectors in play, semiconductors first. The bull case is that the tool is 5 units, years away from throughput parity, and the sell-off hit names whose order books for this year are untouched. The bear case is that terminal share assumptions for Western equipment just took a permanent haircut, and China now has public capital markets funding the alternative. Our read is to separate the two groups. Equipment makers face a real long-run threat and got a wrong-sized reaction. The memory incumbents face a threat that is real, dated, and now well-funded. Second, artificial intelligence infrastructure. 10-gigawatt campuses and 20-year leases are not demand that unwinds on a headline, but watch whether the financing structures keep getting more circular, because that is the late-cycle tell, not the capital spending number itself. Third, high multiple growth, and here is the cleanest case study of the year. SPCX closed near $113.50. That is roughly 50% below its June peak of $225.64 and about 16% under its $135 offering price. And that is after a successful Starship splashdown on the 24th. The multiple was the trade. When narrative premium resets, operational wins stop paying. On the mood itself, from aggregate market and social sentiment monitoring. Positioning has turned defensive, while commentary has not converged at all. The crowd genuinely cannot agree whether this is the top or the entry, and that disagreement is itself the most honest data point on the board. Also worth noting today, Apple passed Nvidia as the most valuable public company in the world. Look at what that derating actually looks like priced out. $225.64 in June, $113.50 on Monday, an offering price of $135 sitting in between, now well above the market, and a successful flight on the 24th that did nothing for any of it. This is the lesson to carry into every artificial intelligence name you own. There is a market regime in which good news pays, and a market regime in which only cash flow pays, and the transition between them does not get announced. It just shows up as a chart that stops responding to wins. On the radar, Wednesday, the Federal Reserve decision, with roughly a 1 in 3 chance of an increase. That is the single biggest cross-asset variable on this board, and everything else this week is downstream of it. Also this week, roughly a third of the S&P reports earnings into a fragile rotating tape with no central bank backstop priced anywhere. Ongoing, whether the Chinese lithography claim survives technical scrutiny. Because reported mass production is not the same thing as competitive yield or throughput, and that is the falsifiable core of this entire sell-off. On digital assets, Senate leadership has signaled there will be no floor vote on the Clarity Act before the August recess, so watch for an actual motion to proceed, not more endorsements. Now 4 new falsifiable calls, dated today. 1. China's program ships fewer than 20 qualified immersion tools into volume production by the end of 2027, falsified by credible confirmation of 20 or more units in production use at the 3 named customers by that date. High conviction. 2. ASML does not cut its 2026 guidance, citing domestic Chinese lithography competition before January 31st of 2027. High conviction. 3. The $250 billion backstop does not close on its reported terms by December 31st. Medium conviction only, because these are early-stage talks with a wide outcome distribution. And 4. The Clarity Act does not become law this year. Prediction markets have that near 33%, medium-high conviction, and grading 1 from yesterday. Our call that oil's war premium would unwind faster than the tape expected is tracking correct. Crude has fallen from the 90s to roughly $81, nearly 8% of it in a single Monday session. Here is where we land. Three things happened this week that look unrelated and are not: a Chinese lithography tool, a $250 billion vendor guarantee, and a rocket that landed perfectly while its stock fell in half. None of those is a demand story. Every one of them is the market withdrawing credit from a narrative. The narrative that the choke point holds, that the buyer is good for it, that the mission success is the business. What is being repriced in 2026 is not earnings, it is certainty. So the question worth sitting with tonight: if the market is done paying for certainty, what is it still paying for, and are you holding any of it? We will learn something about the answer tomorrow afternoon. This has been the Asymmetric Daily Brief. Research and education only, never investment advice. The Asymmetric Signal. One contrarian read a day. Subscribe.